This is Yahoo Finance Live. I'm Julie Hyman. We are watching not much movement in the futures here this morning, but we've had a significant shift as of late, as we've been discussing. The so-called reopening rotation seems to be taking hold a little more firmly. Bond yields have been moving up. Tech stocks have been moving down. Some of the various companies that are going to be reliant and potentially benefiting from reopening of various economies have been on the rise. Let's talk about all of this with Seema Shah. She is Chief Strategist at Principal Global Investor. Seema, it's great to see you. So as we look at the reopening trade and as we await commentary from Fed Chair Jay Powell in just a few hours from now, do you think that what he's going to say is going to put a pause on the reopening trade, perhaps, at least as it's been triggered by inflationary concerns and the bond market?
I think that what we are, at least what we're hoping to hear from Jay Powell, is confirmation that they stay really committed to the average inflation framework. You know, the rise in yields has been driven by better growth expectations and higher inflation expectations, which naturally comes hand in hand with that. What we want to hear is that the Fed is really committed, so that the market believes the Fed pushes down, or at least keeps a lid on bond yields, and therefore enables a reflation trade to continue. Because the concerns at the moment is, of course, that with equities still quite expensive, that rise in bond yields actually puts a big question mark over valuations.
Well, Seema, let's talk a little bit about that question, because I think we've discussed it. Feels like ad nauseum here on the program about the relationship between rates, the relationship between stocks, and how that plays out over time. And we're about 10 seconds away from the opening bell here, so we'll get through that on this Thursday morning as we see the VanEck Buzz ETF. This is the ETF that tracks basically social sentiment and then buys stocks on that basis, ringing the bell down on the floor. But Seema, let's talk a bit about the conversations you're having with clients, that relationship between rates, valuations, how they're thinking about it, how you're thinking about it, and where you guys are at on that question.
Yeah, you know, there's no secret. I think for everyone is looking at risk assets, saying everything is looking really expensive. Now, I think what the general expectation for this year has been is that as we see this global growth recovery, especially in the US, really starting to take hold, you'll see very strong earnings growth, which would then start to validate those elevated valuations. Now, of course, if you start to have a sharper than expected rise in bond yields, you know, that puts a big question mark around those valuations, certainly in terms of the tightening in financial conditions. And, you know, if you do get that premature tightening, then you may see that growth recovery come to a bit of a premature end as well. So I think that's what we're looking for from the Fed, is that reassurance to markets in a way that they really believe. So they have to be really credible about this, that they are going to be very, very patient, and rate hikes are still some way off.
Seema, is it time for investors to begin dipping their toes in some of these momentum tech stocks that have really sold off over the past month? We highlight one of them, Peloton. Peloton shares are down close to 30% over the past month, but they're not alone.
No, look, I mean, I think we have to be, I think throughout the whole path forward from here, we have to be really discerning about what we're investing in. Now, we have a generally positive view on technology. We think that, you know, the very short-term horizon certainly does look a little bit challenging. The rise in bond yields is never really a positive story for growth stocks, but it's really a secular story. Now, within that secular story, there are going to be some companies which are performing extremely well, and that's because they have strong balance sheets, positive cash flow, and a really, really good business model. Now, within the technology sector, there will be some that simply do not, and investors need to be careful what they pick. But generally, we look at technology as a long-term secular play. So there will be moments of volatility as we're going through right now, but we think that this will correct and it'll be returning to an upward trend. It might take a little bit of time, though.
Seema, how are you thinking about policy right now? I mean, the stimulus seems like it's sort of baked into the market here. Infrastructure could follow. Are those themes that you're then trying to invest upon as you're looking ahead to the next few months?
I think you're right. I think the fiscal stimulus package that seems to be imminent is very much priced into the market. I mean, I think it's the reason why we've seen these very drastic moves in bond yields in the recent weeks. An infrastructure package, to us, it still seems likely that that won't come until much later this year, quite likely into 2022. So we're not yet considering that from a global reflation theme, but of course it will add to the very, very positive momentum behind US growth. The one thing that we're hearing from investors really is a question mark over, what are the regional comparisons? What has this fiscal stimulus package left us with? And I think we can say that the US growth story, it seems like it's going to overwhelm anywhere else in the rest of the world. So we're looking at a situation once again where the US could potentially be again an outperformer, but as long as they can get hold of that rise in yields.
Yeah, and Seema, I just want to quickly kind of finish on that point because we spend almost all of our time, probably too much of our time, talking about the U.S. economy, U.S. stock market here on our program. But can you just maybe sketch out kind of what the growth outlook is, in the Eurozone, in Western Europe, where we've seen COVID hit economies quite hard, but it does seem that investors are just kind of focused on the U.S. growth story.
Yeah, I mean, it's probably the most interesting story at the moment. But I think what we're seeing is for the rest of the world, especially for Europe, we are also anticipating a rebound come Q2 as economies start to reopen. The difference is between the US and European economies is simply that the US is going to be introducing a very, very significant fiscal stimulus package, which is lacking in Europe. And that's what's going to elevate US growth over European growth. Emerging markets has been doing well, generally speaking, but we are looking at a scenario where you're having China, India, and the US as the key outperformers of global growth in 2021.
We will be watching all that closely, and we'll talk to you about all of this soon as well. Seema Shah, thank you so much. Chief Strategist at Principal Global Investors. Always good to catch up with you.